Hey, thank you so much for tuning in. My name is Agabus, and this is your financial channel. I've got a great chart today, which would love your take on what you think it might mean. I'll give you my 2 cents, of course. But this one is from Markets Insider. Chart of the day, this indicator shows the stock market is the most overvalued it's been since the dot-com bubble crash. Dun dun dun. This graph shows the S&P 500, one of the largest stock market indexes in the US, of course the top 500 stocks, is now extremely overvalued versus short-term interest rates. They take a look at the S&P 500 earnings less the 90-day Treasury yields. And as you can see on this chart, the last couple of recessions, couple of bear markets we had back in the 80s, pretty steep, significant drop. Right around the dot-com crash in 2000. Here's another one we had in 08, right around this time. And then the last couple of years here, 2019 and the last year or two, it looks pretty similar to where we were, again, dot-com. What does it mean? What do you think? According to the article, the stock market is the most overvalued it's been since the dot-com bubble crash, according to Ned Davis Research. The research firm highlighted the relationship between S&P 500's earnings and interest rates. And listen to this, high cash yields have sparked a rush for money market funds, which has attracted more than $1 trillion from investors moving over since March of last year. The article discussing this chart says that it highlights the stock market is incredibly overvalued. And the research firm notes the relationship between the S&P 500 and the yield on cash, and found that the stock market's overvalued since the aftermath of the dot-com crash. The earnings yield is reciprocal of the price-to-earnings ratio, which helps investors understand how much company earnings they'll receive for each dollar invested in the market. And then it shows the Federal Reserve's rate hiking cycle that began in March of 2022 has drastically changed the valuation picture. According to NDR, Ned Davis Research, since the Fed started raising rates in March 2022, the S&P 500 GAAP earnings yield versus the 3-month Treasury yield has gone from stocks being on the verge of extremely undervalued to being the most overvalued since the aftermath of the dot-com bubble. In other words, it's not that stocks have soared to unrealistic heights, but compared to cash, they don't appear as valuable. With investors being able to earn almost 5% or more on cash, stocks aren't as attractive as they might be in a low interest rate environment. This has led to a surge in assets flowing into money market funds, as mentioned earlier, around $1 trillion. NDR concludes that investors are clearly comparing stocks to cash and liking what they're seeing in cash. As with the previous video, tell me in the comment section below, are you taking advantage of this cash yield that we have? When do you think this interest rates are going to go down? How long do we have them? I'd love to hear your comments. Thank you so much for listening. As I mentioned before, stay curious, stay inquisitive, stay educated, and stay tuned in for next time.